move towards the auto ancillary, and one company which is doing phenomenally well in the marketplace as well as in the stock market and on performance front is CEAT. Look at the stock price, pull up the last 1 year chart and you would know what I'm talking about. The Q3 numbers have come in, good profitability improvement, very healthy margins. Kumar Subbiah, CFO of CEAT, is now chatting with us about the results and road forward. Subbiah, afternoon, thank you so much for your time. Very good performance. Before I get into the details, let's talk about the demand front, both on the OEM side as well as on the replacement market. How did it fare this quarter and what's the outlook going forward? Because talk is again coming back that all these capex and reforms is leading to healthy CV demand and other parts of the market also doing well.
Now, in the quarter went by, we witnessed growth largely in our exports business and in the replacement business. OEM business was muted. Okay, largely in quarter three, the demand from OEMs, particularly post-festive season, tends to be a little lower. So therefore, which we witnessed it in quarter three. In addition to that, from our own portfolio or business point of view, some of the SKUs that we were supplying to a few of the auto majors in passenger car radial tires, we had stopped it in the beginning of the year, and we hope to get equivalent or higher volumes in the later part of the current year. So which is also reflected in the last quarter. So it was flat. OEMs, export business grew by about 20%, and replacement business grew by about strong high single-digit numbers. That's the way we saw growth in quarter three.
So going forward, since some of your, I want to understand your outlook on the exports front. It is a, kind of a subdued global environment we are talking about. How are you managing to outperform export? And also, going forward, how do you see the outlook on both domestic growth and overseas growth, business growth?
See, overseas growth, exports growth is an important priority for us. Okay, and as we stand, exports is about 18-19% of our revenue share. 3 years back, it used to be about 10-11% of our revenue share. So constantly, we took various measures in the last 2 or 3 years to increase the share of exports on our overall growing top line number. So in the coming quarters, in the next quarter, we intend to launch our passenger car radial tires and truck and bus radial tires in the US market and replacement. So it's an important strategic action for us, and we would like it to be successful. And second, we are also growing in certain geographies, and we are facing some headwinds in some other geographies. So geographies where we are growing are Latin America, part of Southeast Asia, and some part of Middle East and Africa. Europe, we are facing some challenges thanks to local environment. And our in terms of our growth plans, we are also investing in our agri radial tires, which is a growth engine for us in many of these markets. So we'll continue to invest behind exports, particularly with respect to growth. And we would like that share of our revenue to go up from current 18-19% to around 25% level in the next 2 years to come. So therefore, that's an important area of growth, and we'll continually work on them. We may have short-term challenges in certain specific markets, which we hope stay as short-term and we'll be able to overcome in due course of time. And we have a clear plan in terms of reaching there. As far as domestic is concerned, generally quarter four would be a better quarter for us compared to the other quarters in a year. As the demand for agri tires generally is more in quarter four. And from our own channel and the distributors' point of view, we work on annual basis, and therefore generally there is a tendency on the part of our own trade, our dealers and distributors also to buy more for them to service during the summer months. And we expect quarter four to be a decent quarter in terms of growth versus quarter three. And large part of that growth we expect it to come from passenger car, two-wheelers, and the commercial category in that sequence and replacement. As far as OEM domestic is concerned, we expect it to grow from quarter four onwards as we have enough pipelines with respect to our own RFQs have been accepted and we start supplying. So you'll see a progressive growth from quarter four on passenger car radial tires. supplies to OEMs as well. So that's the way we see the growth.
Right. Good afternoon, sir. This is Vinny joining in the conversation as well. A couple of things that were highlighted both by Bajaj Auto as well as TVS Motors was in terms of the Red Sea issue, the logistical costs, as well as in terms of the shipments, the time of delivery, that's also doubling as well. So is that a concern that you are facing as well? And because of that, any issue in terms of increase in cost that you would face in the next near term at least?
No, challenges, as you rightly mentioned, there are two areas. One is the cost of transportation. Many of our contracts are CAF contracts, so therefore freight is inbuilt into it. Okay, so therefore, from that point of view, when the freight rate increases, it has some impact both on export of tires as well as an import of raw materials point of view. So therefore, it has an adverse impact on cost. Second, with respect to ability to service our customers, the transit time would certainly increase on account of the recent challenges. We expect transit time to go up as much as 30 days for certain markets like North America and Latin America. So therefore, we expect these challenges to come, and we hope it's a short-term problem. Okay, and in the short term, we would be absorbing the cost of additional freight on our exports. And however, our endeavor is to service our customers, and we try our best to see how to reach those tires to the specific market based on the requirement.
What are the levers you have pressed to get upwards of 14% kind of margins, and what's the outlook on margins? Would you sustain them here? Do you have more juice to extract from the efficiencies? How does it go from here?
I think from our point of view, we had also shared in the previous interaction that we feel worst is behind us, and we are in a comfortable range as far as margins are concerned, and 14%, 15% kind of a gross margin is a healthy margin. Okay, I'm sure it's also translates. The margin improvement also leads to a higher profit before tax, after tax, and leading to improvement in earning per share. So scale is one of the important levers for us to sustain margins at a healthy level. Second is the right mix. Okay, right product mix is important. Okay, and particularly if we sell more in the replacement and exports, our margins tend to be better. And third is our own focus category of passenger, which is passenger car tires and two-wheelers plus agri radial. These are the focused categories from margin standpoint. One of the important elements that influences the margin is that raw material cost. In the previous 2 years, we faced some gross margin related challenges on account of continuous increase in raw material costs. And it looks like raw material costs will operate within a band. Okay, should that sustain, I'm sure we will be able to maintain a healthy margin, which could be 12% to 14, 15%. In that band, we are comfortable in terms of operating.
Right. So just one more question in terms of, obviously, this time around also sequentially we've seen that your debt has surely reduced. There was healthy cash generation. So 160 crores in terms of reduction in debt. What is the plan on that terms, and where could we see that moving in terms of debt reduction plan?
See, it's a good story, honestly. If you really look at not only the last quarter, if you really look at last 4 quarters, our debt has come down by about 600 crores. Same time last year, that is the end of December 2022, our debt was around little over 2,300 crores. Now it's come down to 1,700 crores. And our leverage ratios are very healthy. Okay, and we are comfortable with current level of debt EBITDA of about closer to 1.1, and it used to be around 3. And debt equity is under 5. Now it's about 0.44. So we are very comfortable at this level. If the business continues to operate at current levels of margin, which is about 12 to 15% kind of a margin, even after factoring in 800 crores plus kind of a capex, we should be able to generate reasonable cash. Our operating cash flow has been very healthy for the last 4 quarters, and we expect in the current year, first 9 months, we incurred about a capex of about 600 crores. So despite incurring that capex of about 600 plus crores, we still managed to bring our debt down by 360 crores. So we hope this trend continues, and we are able to bring the debt level down. We are at a comfortable level. Our endeavor is not to under leverage. Okay, while over leverage is bad, it doesn't mean that under leverage is good. So we like to utilize this cash to put into the business in a manner that it's able to, bring in more efficiencies, give us the right level of returns on the additional investment. And in yesterday's board also approved some capex, which is over a 3-year period for us to keep ourselves ready for creating some upstream capacity, work on solar, work on some investments that will give us some higher margin product categories and things like that. So we continue to use the cash that business generates into the right areas so that we are able to sustain these margins.
Absolutely, sir. Thank you so much for joining in with us this afternoon on ET Now, giving us an understanding on the outlook for the company going forward as well. That was the management of CEAT for you all talking about worst is over in terms of margin. They are comfortable in terms of margins. 14-15% range is what is something that is sustainable for EBITDA margins. Look at the last 6 months, stock has seen a sharp spike up of 15% as well. But on that note,